Okay, everyone, welcome to today's presentation. We are going to be talking about capital gains planning for real estate investors. You may have heard of some ideas. You may have seen some articles on it. It can be a very, very complex topic. There is so much that we can discuss in this area. At the same time, sometimes the answers to your capital gains planning situation is very simple. And sometimes you may find that there's no capital gains planning at all. So what I'm going to walk you guys through on this webinar that will be recorded and also you'll be able to find this on YouTube, on any major podcast platform. We're going to talk about what is capital gains, because a lot of people, you'd be surprised, misidentify capital gains. How is capital gains taxed? So these are going to be some more foundational concepts here. And then we're going to go into what reduces your capital gains taxes. Then we're going to go into some foundational capital gains tax strategy. And finally, we're going to move on to advanced capital gains tax strategies. And this is where my other tax accountants and CPA audience members can really get some value out of this, and general listeners as well. And we'll talk about what can you do, what you should be doing for capital gains tax planning. And before I jump into this, in case you know anyone else who is interested in our services, tell them to email info@markperlbergcpa.com, and we'll be able to maybe set you up and see if we can help you out. Also, if you know any staff that can join the team, same email. All right, let's get into it. Let's talk about what capital gains is. Profits from the sale of a business asset. Now, there's tons of transactions that can qualify as capital gains. For instance, the sale of your business itself, the sale of stock, the sales of business assets that are not real estate, like your truck. But we're just going to be talking about real estate capital gains tax planning. So another thing I want to emphasize here is that house flipping is not capital gains income. House flipping is not capital gains income. I got to say that twice, because so many times, in fact, I was just on a call today, we meet house flippers who want to get that favorable long-term capital gains tax treatment. It's not the case. Even if that house flip takes longer than a year, it still is not capital gains treatment. What determines whether or not it is a capital gain is if you have broker-dealer status on that property. Jumping a little ahead on the slides here. When you sell a rental property, though, that event is capital gains. So what we're going to be discussing here is what is the tax treatment when we have a rental property and we sell it for a profit that is going to be capital gains. In this instance, we do not have that broker-dealer status. We're not in the business of buying and selling real estate for profit. We're in the business of rental activity. Or let's say you have real estate for another business purpose. So let's say you have a commercial space for your dentist practice. Those are fixed assets and are going to get the capital gains treatment. All right, so now that we have a clear understanding of what capital gains is for real estate and what our topic of discussion is, let's dive a little deeper into how capital gains is taxed. Well, capital gains, I got cat hair all over my face from that cat now. I'm so distracted. Sorry, guys. I think I'm allergic to cats. Okay. So, how is capital gains taxed? There's no self-employment taxes on capital gains, which is a wonderful thing. Now, for some of you who have never worked for yourself, have never been independent contractors, capital self-employment tax can be incredibly expensive, and people don't realize it. I call it the silent killers of entrepreneurs, because you may find your self-employment tax is greater than your federal and state taxes, and you don't even see it coming. We'll have other discussions. You can see some of my prior webinars when we go into self-employment tax planning, but there's none of that with capital gains. So it's going to have preferable treatment. There's also something a lot of people forget, which is called recapture tax, depreciation recapture tax. What that means is if you have taken depreciation on this property, when you sell it, you are going to have to recapture, and any depreciation is going to be recognized, assuming the price exceeds your cost basis in this property. So there's taxes on that depreciation recapture. If there's no cost segregation studies done, that's going to be a 25% tax. If there was a cost segregation study done, the recapture of those items pulled out for bonus depreciation is going to be taxed at your marginal tax bracket. Short-term capital gains, if you own the property for less than a year, it is taxed at your ordinary marginal rate, which is impacted by all your other sources of income and what tax bracket you're in. Long-term capital gains have a more preferential treatment. So you have the property for over a year, you're going to typically be taxed at 15%, but we're going to go into more specifics on that and break that down in just a second. Another thing people overlook is state taxes. Yes, the state will tax you on your capital gains as well, most likely. We often find that the state tax mirrors the ordinary income taxes, and it's the similar rates that you're paying taxes at your W-2 job or your businesses. And then finally, there is potentially net investment income tax, an additional 3.8% tax on your capital gains. And let's dive into more specifics on what that looks like here. Married filing, this is what happens. These are the people who may be paying an additional 3.8% net investment income tax on their capital gains. We have, if you're married filing joint and your income exceeds to $250,000 or 125 if you're MFS, single $200,000, $200,000 for head of the household, or $250,000 for a qualifying widower. If your income exceeds those amounts, your capital gains will also be subject to that additional 3.8% net investment income tax. So a lot of people think that the 15% is not so bad. Remember, we got our state taxes, and we have an additional 3.8 that you may be paying as well, and we have a potential depreciation recapture tax. So let's look here at the long-term capital gains rates here. And there's a lot of planning that a lot of accountants completely miss out on in considering the long-term capital gains rates. And there are strategies we can do, we'll talk about later, where you can actually drive clients into the $0 long-term capital gains rate, simplify your tax planning, and eliminate the taxes. But if you are single and your income is between $0 and $44,625, you could be in the 0% long-term capital gains tax bracket and pay absolutely nothing in long-term cap gains. And that amount is up to $89,250 if you're married filing joint. So imagine this, almost $90,000 of free long-term capital gains if we can drive you into a $0 tax bracket with other strategies. Most of our clients are in the 15%. That's $44,000 to $492 if you're single, or $89,000 to $554,000 if you're married filing joint. And then if you're above those thresholds, you're going to jump into that 20% long-term capital gains tax bracket. All right. Now let's talk about what can reduce your long-term capital, your long-term or short-term capital gains. So let's say we're going to have some capital gains from real estate here. A capital loss, either from other real estate or from your stocks, will offset that capital gains taxes. So let's say we have a capital gain and all of our strategies have failed. We tried to do a long-term, we tried to do a 1031, couldn't find a qualified opportunity zone, but we have some stock and the stock's basis is lower than the cost. We can sell that stock and the losses from that stock will offset the capital gains from the real estate. And it could be long-term or short-term losses from those stocks, and vice versa with the real estate. Real estate tax deductions from all of your properties will typically offset the capital gains on the sale of any single property. So if we have one property that is selling for a profit and we have capital gains, we may find that if the other properties are operating at a loss, some of those tax deductions will actually come through and offset the taxation or eliminate the taxation on your capital gains. And then finally, there's another topic here that a lot of people fail to consider. And we also see a lot of errors on tax returns, and that has to do with passive activity loss carry forwards. So what that means is this is all really common when we have clients investing in real estate and they don't have real estate professional tax status. When you have losses from your real estate and you can't use them to offset your other sources of income, they're just unused. You don't have real estate professional tax status. You don't have other sources of passive income. They go into this bucket. You'll see it in Form 8582 of suspended losses. Those are going to be activated if you have a capital gains event that is potentially taxable from your real estate. You're going to pull from this reservoir of suspended losses from all your rentals, and it's going to offset the potential capital gains here. And now let's get into the good stuff here. What are the foundational tax strategies that we can use to offset our capital gains here? One of the things I mentioned, and this is just re-emphasizing this because we see a lot of accounting firms that are not specialized in real estate missing this opportunity. Make sure you're carrying forward your passive losses from the prior years. Now, most tax software is going to do that for you, and it's going to carry forward automatically. But let's say you have a new accounting firm and they're taking on your financials and they're looking at your prior year return. They may have missed that. So make sure that that is being accounted for. Maximizing your deductions. Here's the next easiest way to offset your capital gains here. Make sure you're recognizing all of your tax deduction, your mortgage interest, your insurance. So many people missing out on their insurance and forgetting it's a tax deduction. The tax preparer fees, travel, et cetera, et cetera. All of these things are going to help offset the capital gains. And this is really important because we have a lot of clients who may say to themselves, I don't have real estate professional tax status. I don't really need these tax deductions. We're operating at a loss anyways. It's not going to reduce my tax bill in this year. Well, if that's how you're thinking, you're going to miss out on future tax savings, and you're going to set yourself up for a larger tax bill in the future. If you wind up selling these properties and you have a capital gains event, you're missing out on the ability to use those prior unused deductions and losses to offset your capital gains. Another very common strategy we've done a lot of is 1031 exchanges. A 1031 exchange at a high level here, what you're doing is if you're selling a property for a capital gain, what's going to happen is you have 45 days to identify a replacement property or group of replacement properties. And you have 180 days to buy that replacement property. And as long as that property's basis, or let me say it more simply, as long as that property costs as much or more than the property that you're selling, you're going to be able to see a deferral of the capital gains. And I want to, as we're talking about 1031 exchange, I also want to dispel a urban legend about 1031 exchanges. You do not have to hold a property for longer than a year to do the 1031 exchange. Even if you had it less than a year, you could still do a 1031 exchange. I got another urban legend to dispel here. If you have a property for less than a year, it still might be treated as capital gains. Let's say you bought a rental property and someone comes up to you with an offer you can't refuse, or whatever circumstances encourage you to dispose of the property, and you had it for less than a year, you can still have short-term capital gains tax treatment on it. So the 10, if you're interested in learning more about 1031 exchanges, I had a really wonderful conversation with David Foster called 1031 Exchange Strategy Stacking. Now, I just gave you a high level explanation of what a 1031 exchange is. But if you really want to dive deeper and explore all sorts of strategies, you can have a lot of fun with this. Listen to my podcast on that one. We go into multi-asset 1031 exchanges, construction 1031 exchanges, reverse 1031 exchanges, all sorts of creative ways you can do this. And it doesn't just have to be a single family rental for a single family rental. It just has to be real estate for real estate. You could be exchanging a multifamily for a short-term rental, a farm for a convenience store. There's so many ways that we can do this. And if we're proactive and understand the tax law, we can really create some wonderful opportunities. And finally, another good strategy we like to do, and this is often if we don't want to buy a replacement property or the stars just don't align perfectly for the 1031 exchange with the 45 and 180 day limit, we do a cost segregation study. What we can do here is, just like I described earlier, because of your real estate losses will offset your capital gains. If we see some capital gains about to hit your 1040, and we can do this even as we're filing your return and evaluating your situation, and after the year is closed, what we can do is a cost segregation study to accelerate that depreciation, get you some bonus depreciation tax deductions, even if it's not on the property you're selling. We'll do a cost seg on another property to create some passive losses that will also offset your capital gains from the real estate. Very common, and a lot of times a lot easier than a 1031 to pull off for some capital gains planning. And as you can imagine, I also have anyone who's listened to my other content knows I talk about cost segregation every day of my life. I have a whole podcast on that as well, and webinar with Yona Weiss. You'll really enjoy it and get a lot of value out of. Now let's get into some of the advanced tax strategies that you may also want to consider. Qualified opportunity zone funds. Qualified opportunity zone funds allow you to defer the taxes on your capital gains. And as of right now, and note that it is June 14th of 2023, so the law may change on this and be more favorable. But as of right now, the capital gains would be deferred until the end of 2026. So what happens with the qualified opportunity zone funds is you have 180 days to reinvest into the opportunity zone. What's cool about this is, unlike a 1031 exchange where you have to identify the property and give it to an intermediary and identify that property within 45 days. Unlike with 1031 exchanges, you could do a qualified opportunity zone well after the sale of the property, even after the year is closed, going into the next year. You can put the gains into a qualified opportunity zone fund. And unlike a 1031 exchange where all the capital has to be rolled into the replacement property, you only have to roll your profits into the qualified opportunity zone fund. And unlike a 1031 exchange where your basis is reduced by the deferred gain and you get less future depreciation, you're going to get access to all that depreciation available on your basis in that property. So lots of advantages with the qualified opportunity zone fund. You can also even invest in businesses in qualified opportunity zone funds to defer your capital gains. Now, even though we're deferring it to a later date and you're eventually going to recognize the gains, you're going to get distributions and profit, and you're going to reinvest your profit in tax savings over time. So by the time the taxes are due, you've seen the economic benefit, and then the distributions are going to help you pay for that tax liability when it comes due. And also remember that if you're working with people like us, we'll have an additional plan in place to offset that future deferred capital gains. Another idea you probably haven't heard of is Delaware statutory trusts. Delaware statutory trusts are going to allow you to, very similar to a 1031 exchange, you're going to roll your funds into a trust that's going to invest into real estate. You're going to be passive. You're going to see the benefits of cash flow and tax savings and depreciation. The only difference is that you're not going to have to manage it. You're going to have another fund that runs and controls everything you got to do. You just contact the person running the Delaware Statutory Trust, and they're going to help you out with executing that tax deferral strategy. Now, I just want to also, if you guys have any other questions, feel free to put them in the chat. I don't see anyone asking anything, but feel free to put them in as we talk about all of these ideas. Another idea I really like here is installment sales. Remember, we talked about earlier, and a lot of people miss this with installment sales. We have the different marginal brackets for the long-term capital gains. So if we spread out the capital gains event with an installment sale, where we're selling it over time to the buyer, we're going to spread out the recognition of that capital gains. And it's going to prevent you from jumping into the higher capital gains bracket. In fact, we may find that you are in a $0 capital gains bracket. So instead of recognizing all $500,000 of capital gains in year one, an installment sale is going to allow you to break up the payments that you receive from the buyer into several years. So if you, instead of recognizing, for example, a $100,000 capital gains in 1 year, if you sell it over 5 years, you're going to recognize the $20,000 of capital gains each year, spreading out that capital gains event in tax liability and hopefully dropping you into a lower tax bracket. Now, there are some additional to that, you have deferred sales trust, which will allow you, let's say you're going to structure it by which the buyer is going to pay for this property within a trust. All the cash is received by the trust, but you're still going to break out the way that you actually receive the cash and are taxed into it. So even though it's not an installment sale, a deferred sales trust is going to allow you to spread out the recognition of that capital gains. There are also charitable trusts. Now, there are several ways that we can do this where we're involving charitable organizations and trusts, and this can get to be a very, very complex conversation. But at a high level, what you have the opportunity to do here is if you dedicate this property to eventually go to a charity, typically at your date of death, there are other ways that you can structure this, but basically you're going to be able to say that this property is going to eventually go to charity. And in the meantime, because it's going to charity, you get a tax deduction and you're not going to pay the same amount of capital gains, and you're going to have access to this cash to reinvest. There's all sorts of charitable organizations and structures that we can integrate into a tax plan that can save our clients millions of dollars in taxes. And if you work with the right people and you understand this approach, it could make a lot of sense. And then there's finally a structured sale, which is you would really need a significant amount of capital gains in this instance for it to be worthwhile. So we're talking at least $1 million of capital gains, probably more for this to make sense, but it allows you to see the economic benefit of having your cash up front, but also using a trust structure so that you're recognizing the capital gains not immediately, but spread out over several years. So there's lots of different opportunities here, and capital gains can get incredibly complex, as you can imagine. And a lot of times there's no one right answer. So you got to collaborate with your advisor, run some scenarios, figure out what do you want to do with your cash from the capital gains? What are your needs? So we can best create a solution for you. But this is what you should do if you want to minimize capital gains tax and you know that there's going to be some potential liabilities, or maybe you don't know there's any liabilities at all. First, you want to make sure you're working with a qualified tax advisor before the sale even occurs. So let's say that you think you're going to have a capital gains event. You don't even know if they're going to be paying taxes on it. For all you know, there's suspended losses and other deductions, and the impact is absolutely nothing on your tax liability. So if that's the case, and we know that there's going to be zero taxes, you can verify that with your advisor, and then the case is closed and you can move on. But you may decide that there are other opportunities. So you want to schedule a meeting with your qualified advisor to estimate the potential tax liabilities. So you should be able to run the scenario and see what is the impact if you do absolutely nothing at all in response to this capital gains event. If you find that the tax liability is nothing or minimal, then you can move on and your capital gains planning is likely done for this transaction. You also want to explore some pre-sale strategies. What I mean is that what can you do before the sale of the property to reduce your taxes? So if we think that there's going to be a capital gains event, what can and should we do before the sale of the property to reduce the taxes? So that may involve things like pushing back the sale of the property. So instead of selling it in July, you decide to sell it in September so you've owned it for more than a year, and now you go from short-term to long-term capital gains. Maybe you decide you're going to do that 1031 exchange, so you coordinate with that exchange intermediary beforehand. Or maybe you start negotiating an installment sale or another type of sale agreement with the buyer that's going to create a more tax advantage situation for you. These are all things that you're going to want to consider before the sale of the property. But let's say none of this works, or let's say you failed or forgot to contact your CPA to do tax planning. There are tons of other things we can do after the sale of this property to mitigate or completely eliminate your capital gains, such as doing cost segregation studies on other properties, maximizing your tax deductions through all of the foundational tax saving strategies and deductions that you should know about. And there's also the qualified opportunity zone funds. And another opportunity here that a lot of people forget is that if you own a business, we can consider some business tax strategies and driving you into a lower bracket on the business side to result in a lower capital gains tax. What I mean is that, remember, if we are married filing joint, our first $90,000 is untaxed on capital gains. We might find ways to have additional deductions, maybe buy some vehicles, maybe get some Section 179 deductions, drive you into a $0 tax bracket, and now we've eliminated $90,000 of capital gains subject to tax. So we may also find that, okay, maybe we'll have some capital gains tax, but from the sale of this property, we have tons of cash and we want to redeploy this in our business. And the savings we get from getting a deduction in our business, which is taxed at the marginal rate, will offset the capital gains on this transaction. So many different ways to look at this to reduce your taxes. And what's really important here is that you work with a tax advisor who understands your situation, all of your different sources of income, and can really help you make the best decision based on all of your circumstances and all the opportunities available. So this is a high-level introductory discussion of capital gains I want to give for our audience, but we could probably do an entire series and talk for weeks and weeks and weeks on this topic. We could also probably write a $30,000 page book on different capital gains strategies. So I want to go to you guys now. I've gone through all the slides and I want to get your thoughts and your questions if you have any on capital gains events. So I'll give you about 5 minutes to put some questions and see if there's anything I can help you out with while I have you here. Let me know your thoughts and let's see what you got. Okay, so doesn't look like we have a very curious audience today. I'll give you guys another until another couple of sections to post your questions in the chats or the Q&A. And it looks like I've answered all your questions. Okay, so thanks a lot for your time today, guys. I hope you got some insight out of this capital gains discussion. If you want to dive deeper into any of these topics, just go onto my page. We've done some exploration of qualified opportunity zones and 1031 exchanges. If you're interested in learning on some of the other strategies, feel free to reach out and maybe we'll do some deeper dives into these conversations. Capital gains planning is a lot of fun. There's a lot of different things to consider. And you want to make sure that you're looking at all of your sources of income and evaluating all the possible opportunities here. Hope you guys got something out of this. And again, if you know anyone who can use our services, tell them to email info@markperlbergcpa.com.